Hi, welcome to Super Investors Podcast, where we discover and connect with the top 1% investors. Today, on our first podcast, we have with us Mr. Sanjit Singh Paul, who is the managing partner and the principal officer of Modulor Capital, a SEBI registered investment advisory firm. Sanjit shares with us his learning from his 15 years of experience investing in the equity markets, discusses about his quantamental investing framework, and also shares the outlook for the equity markets in 2024. So without much ado, let's get started. Hi Sanjit, welcome to Super Investors Podcast. So we're so thrilled to have you today in our conversation. So
Fantastic. Thrilled to be here.
firstly, before we start, congratulations on the stellar performance on our investments this year, especially on the Tornado Deep Value portfolio, which has given around 92% returns this year annually. So before we dive deep into the conversation on your portfolios and investments, would you like to share a brief introduction about yourself and your background?
Good, I'll do that. So I have been in the market since 2006. So I can say I've seen six beer markets, and I'm an engineer by education. That was in 2005, and then in between I did my MBA from ISB. It was in 2010-11. Right, that's where I formally studied finance. So when I began in the markets, I was a newbie. I was a little kid trying to make money, and then after about 6 months, sitting with a sub broker, on the terminal, and back then internet trading wasn't, the thing. You had to sit on a terminal. I was transferred to the broker's office, saying that this kid has, some idea about charts, and why don't you use him? So thereon, started to trade with the brokerage in Chandigarh by the name of Competent Finman. I learned most of my trading stuff over there. Brokerages are back then they used to do proprietary trading, and now they mostly do proprietary trading only. And thereon, I started to see the charts, and I used to trade derivatives, do futures, and sometimes do options. And in 2007, there was a P notes ban, right? And the market had frozen down in the morning, and then later in the day, the finance minister, Mr. Chidambaram, came and said that they'll be deferred. The ban is deferred for some time, and the markets came up. So technically, that was the first time I figured that there's going to be a crash, right? But I was too young, and you don't have conviction in your own analysis when you're young, and you're like, yeah, this is good. So I told my broker, Mr. Chawla, that there's going to be a crash, and markets are in the 6,000 plus range, and they're going to come down to 60% down or something like 2,500. So he said, there's something called PE. The markets just don't go haywire. And in the coming year, that happened, right? My broker did make off money. He bought put options, and then he sold them, at two times the price, and then some of them at three times the price. I didn't make much money because I didn't have much capital, and I didn't know what to do, right? So then I figured that yeah, there is some bit, there's some bit truth in technical analysis. It's just that you have to make sense of it.
Mhm.
And then I was looking to study finance and get more of fundamental analysis and quantitative analysis. Quantitative was still a little hidden back then. Technical was accessible to everybody. Then when I went to ISB, I had a professor by the name of Sandhar, who was a hedge fund manager, and he would teach a subject called trading systems and strategies. And that's where I learned that you can use an Excel sheet and you can really model stuff, and not just fundamental data. You can also model price data, and you can do everything is allowed to be put in an Excel sheet, and you can mix and match. So that's where I learned about quantitative investing. And then later on, when I came back from ISB, I joined back the same brokerage, and we were doing algo trading with them. So I traded everything, futures, options, commodities, currencies, everything. And I used to start like 9 o'clock in the morning, and forex market starts then, and go around till 12:30, till the MCX, shuts operations about gold and crude oil. I did that for a while, but then I figured that it's not really viable to do 9 to 12. It's nice. Trading, and especially algo trading, is very addictive, right? And over the next few years, by 2015, I realized that you can make nearly the same amount of money investing if you do it systematically, if you have your capital, of course.
Yes.
than you can do, doing trading. So if you really trade futures and options well, you probably make about 2% a month. And if you're like really top edge,
Okay.
and that's not risk free, but somewhat mitigated risk. You are buying and hedging and selling and everywhere. So, and you pay 30% tax on that, because it's trading income, business income. But if you invest well, then you can probably make that same 24%,
Mm-hmm.
right, annually. I mean, if you're like really top edge, and you can pay lesser tax on it, maybe 10% or maybe 15%, if it's not too frequently traded. And then you live longer also, because you're not all the time glued to the screen and looking where the market is going. But then as now experience in markets, with 17 18 years down, I understand that if you have spent time as a trader, only then can you look into becoming a good investor as well.
Yes.
Pure investing doesn't bring about, pure trading doesn't bring about, you have to go through. And because of my experiences starting as a technical person, getting quantitative, then in 2015 to 17, I worked with a fund also, doing their an early stage fund doing their quantitative analysis. And there I understood that fundamental also has a place. But in listed equities, it's not just the inside information, it's also the positions everybody is taking up. So all through my career, I have been into technical, I have been into fundamental, and I have been into quantitative. And in the end, the brain is a nice mix mash putty of things, and then it says, this works. So I work in Venn diagrams. This is fundamental, this is
Mhm.
quantitative, this is technical. This
Mhm.
is the area which overlaps, which
Yep.
all three agree upon. These are the stocks we should pick up. So that's how it works. Uh, Recent performance of markets has been very good.
Yep.
uh, I wouldn't say we have been purely lucky, because we, positioned ourselves to do this.
Absolutely.
But then the returns always come from the market,
Mm.
not from the manager. The manager ensures that you don't do stupid things and lose your money. But the returns, I hadn't planned that the market will, this portfolio will go up 80%. It could have gone 20, it could have gone 50, it could have gone like 120. It went by 80, 90%. So it's mostly doing the right things, and then the results come. So that's how my career background has been through. Just figuring out what not to do, and doing the right things, and then the results come in.
Quite fascinating journey that was. I believe you also co-authored a book, right? What my MBA did not teach about money. Uh,
Yes, yes.
I think it's quite a fascinating title by itself because I can relate to it very much. I think the education system in India, especially the management and the B schools, they teach students about how to, prepare yourself for a career in the industry rather than how to handle your own money, your own wealth, and preserve it, right? That's completely lacking in the system. And I think the title aptly suits for this gap. So, can you tell a bit about how you approached the book and how it came about?
So the book is quite a baby. It talks about the other interest I have, which is part of the profession I do also now, and it talks about personal finance,
Mm.
and everybody has an idea about money.
Yep.
And unfortunately, the education system, and not just the education system, society per se,
Mm.
talks about what you earn, but does
Yep.
not talk about what you do with it. It doesn't teach you good principles. When I was growing up, stuff about mental health wasn't taught. Now kids are more aware.
Yes.
Stuff about money wasn't taught. We were still a closed society, so stuff about the opposite gender wasn't taught. Much. And there's like a bunch of topics which are essential life skills, but were not taught. And when I went to MBA, I talked to my classmates, and everybody, knew how to evaluate,
Mm.
something, how to value a stock, what is the best investment, what is best this and that. But when I came through MBA, and then, when I started to interact with people, and then, more likely when we came down to advisory in 2019, we figured out that people really don't connect uh, the knowledge they have about markets and stocks and things to their own lives, right? So they don't really have a model around it, and most of analysis they do with the cold brain, their business brain trained brain, with a model and a set of rules and a set of parameters, and they do this very well for their own companies, but they don't do this very well and plan for themselves. Most smart people will have figured out a model, but it's not essentially the best model or the right model for them. It's mostly what they have learned. So when there's a tough problem and your brain doesn't have a model for it, it drives one. So let me do this much, and people come up with uh, I read books which said you should make 5 bank accounts for 5 different things, and I was like, wow, do you know how much what an accounting disaster that would be, right? You make 5 bank accounts, one for your spending, one for your long-term goals, and one for this, and what do you do with from those 5 bank accounts? You do FDs, right?
Yeah.
And then for the markets, you look for romance, right? That some romantic return is going to come and it's going to fill my pockets and I'm going to become rich overnight. And then I figured that most people are using markets to become rich. You don't use markets to become rich. You use markets to stay rich. You do other things to become rich, and then you stay rich that way. So this book, me and my co-author, who's 20 years my senior, he's into distribution and he's also an MBA. And he said, even 20 years ago, even I didn't learn these things, in my MBA. So like high five. And it's the same problem we keep on having, over many years. So let's write a book about it. So the book talks not about, how to do your credit card debt, and mostly when personal finances talk about, everybody talks about credit card debt
Mm.
and loans and housing loans and everything else. Nobody talks about the aspect of money which you should have known. What is money, and what you need to do about it. So we talk about two perspectives in this book.
Mhm.
The human perspective and a financial perspective. Human perspective says that you're emotional about money, and you will use money to patch your needs and fix your problems and everything else. And the financial perspective is how money works, how markets work. Markets don't care when you need the money. So say you have an emergency need which is not covered by your insurance, and you need money and you need to pull out from your portfolio, but the markets are down by say 30%. You'll have incurred a loss, right? And you would have got bad returns. But at that point of time, it doesn't matter,
Mm.
right? Because you need it. So that's the financial perspective, the cold thinking of how the whole world is working, ups and downs. And the human perspective is how your life is working and how emotionally you think about money. So that's what the book talks about. A little different from the regular don't make 5 accounts and use this kind of instrument for your financial freedom. We don't talk about these things. We even have a model on retirement in the book.
Mhm.
It says you should never stop working. You
Yep.
should stop working for money, or your need for money should be eventually taken care of. But why would you stop working? If you're good at something. So all these things is what we talk about in the book, and we talk about psychology, and then we try to suggest humbly, try to suggest models around it,
Mm.
that if you are doing this, how should you go around it, or build an activity. We've used a example where it's actually a real life example which happened with one of my pilot friends,
Mhm.
that how pilots handle an engine failure or a bird strike, or how do they handle turbulence. They have a standard reference book,
Mm.
and they're trained to do these things. So the first thing they do is they suppress their panic button,
Mm.
right? Now, and then they follow a process. They know how to come out of it. That's what you do in markets also. When the markets are falling, or they're about to fall, or something has happened, you don't press the panic button and you start selling your holdings. You have a plan that let me keep this much cash, but that comes from pre-preparedness. you know Being prepared that you have to have this much cash when the markets are up. So these are the things we talk about, and the whole book is just a set of bunch of models. And I'm not a great writer. Neither my co-author is a great writer. He's written 2 books now. So, but we've tried to put those models in a easy way to understand way, where you can relate it with your life. Because if you cold cut model, it will be very boring to read. It's a bad book. So we've tried to put in examples from people we know, and how they have behaved into different scenarios, and putting them across. So yeah, that's what the book is all about.
Great. I think it will be a great read for all our listeners. But I would disagree where you say that you're a bad writer because I've read all your blog posts on your website and medium.com. So I think it was a pretty fascinating read on, especially this framework of quantamental investing, right? I think it's a treasure trove for anybody who's interested to learn about quantitative and quantamental investing. So let's get there now. Let's understand your portfolios and your investment framework and what exactly quantamental investing is, if you can break down to our listeners.
So you've asked the right question, what is quantamental investing? And from there on, we'll flow into how the portfolios are constructed. So when we say quantamental, it is quantitative and fundamental,
Yep.
it's a patch word. It's not really a word in the dictionary, but it's the investment industry's jargon, they put it on. So quantamental is very realistic. Now, in one of these articles, we put that, investment managers, people who manage investments, are not purists. You will not find a fundamental value investor always doing value investing. He or she will also, they will also be referring to the 200-day moving average.
Mm,
Fine, you found a great stock which is of value, but then, you have to time its entry. It's
mm,
better to get into that stock when it's nearer to its, say, 200-day moving average. We don't use the 200-day moving average, we use something different, but then that's a great way to do it. So not even a purely fundamental investor, who talks completely about fundamental, will be doing purely fundamental investing.
mm,
That, this company is undervalued, let's buy it.
mm,
Right, they don't just like go, today we have determined it's undervalued, tomorrow we'll go and buy it. Doesn't happen like that. You have to wait for timings, you have to wait for entries, and you have to see, liquidity is available, position sizing is, what positions you should take and how you should build it up. So, and analysis keeps on going on. It's a building situation, right? Now what quantamental says, that our objective is to make money,
mm.
is not to be right, is not to be the, most talked about person in the party, right? But it's to be making money. How
Absolutely.
do you make money? With everything. So if you know fundamental analysis, but you also understand 200-day moving average, then use both,
Hmm.
right? I said it's a Venn diagram,
Correct.
one circle and the other circle, wherever, the overlap is, there you can have a higher confidence on whatever you have analyzed. And then we add technical analysis also to it, right? We say, how are you make money when everybody else also agrees upon the idea of what you've bought. So if you bought a stock and others outside also agree that, oh yeah, this is a good stock, and they also notice it, right? Only then the value will go up,
Yeah.
right? Only then, to realize people will want to be paying higher value for, what you own. So that's how you make money. So now Quantamental says, you have to look at technical analysis also, because it will tell you how positions are being made in the market.
Hmm.
You can hold a stock, it may not move for 3 years, and then it gives a great return in the 1 year, but your return is going to be over the 4 years, right? And your CAGR, is going to be lower,
Mm.
right? So it's better to not put money in there, identify a value stock, but sit on it for a while till it's ready to move, and you have to figure out some patterns. So to get good returns, you have to, and then you have to of course sell it also. That's a
Yep.
separate, we can probably do a separate, whole podcast on when to sell.
Yeah.
That's the big thing in life, right? So you have to figure out what is a good stock, when to buy it, how much to buy it, how to mitigate your risk, and when to sell it, right? And then you also have to compare it with others. Now this is how we build our portfolio. So we say, let's do fundamental also, let's do quantitative also, and let's do technical also.
Mm.
And on top of that, we do two more things, which is understand whether the market is investable or not.
Okay.
Is it too expensive? Don't invest. Is it falling? Wait a while, right? And we have to do a last step of position sizing. That how
Mm.
much confidence can we ascribe to this analysis,
Mm.
from a default, state to a state. So the first stage, is how we build a stock portfolio. We
Okay.
also build, index portfolios and gold and multi-asset portfolios. Let's put them aside. For example, tornadoes. How do we approach tornado?
Mm.
So first thing we do is whether the market is investable or not,
Okay.
right? So that's is a process we call tactical management,
Sure.
right? So tactical management says whether you want to be in the market and where is the market in its market cycle. So saying that you can buy at any price is a good way of getting low returns,
Mm-hmm.
right? There's some price you don't want to buy something, not even a stock, nor not even the market, right? For example, right now people are very edgy about that. markets are very high, but everybody's speaking that, oh, till the elections the markets are going to go well,
Mm-hmm.
right? So we have to logically and clearly assess where in the cycle is the market now, whether there's potential to go up or down. And it's not a yes or no, it's more of a probability question.
Mm-hmm.
Say if it's a 55% chance that the market can go up, then there's also 45% chance the market can go down. So you will assess the probability and you'll say, okay, let we can take risks at this stage of the market. We can take these types of risks, for
Mm-hmm.
example, right? So growth is good, sentiment is good, value, fewer opportunities. Be more selective. So tactical management tells you when to be in the market, when to be out of the market.
Mm-hmm.
Tactical management also does one more thing. All of our portfolios are also multi-asset,
Okay.
which means that these portfolios will exit equity at some point of time, maybe partially or completely, and go park themselves in a different asset, maybe cash, maybe gold, or whatever instruments are available, and which match the strategy, right? So tactical management will tell you whether to be in or not. Then next stage comes to define the universe. Now, say you want to do what is the kind of strategy you want to do? We
Mm-hmm.
do three types of strategies.
Okay.
One is called a value strategy, one is growth, and
Mm.
one is sentiment.
Sure.
Right now, tornado is a value strategy, right? So we will now look into defining the universe of the stocks. You can't say all stocks I will look into, right? We have to take a specific type of risk and give it a specific type of return. So we look into small micro caps for
Sure.
tornado, right? And then we say, okay, it's a risky universe. Let's select risks. So first step is to define the universe. Then we will apply a fundamental filter to say what are the stocks we don't want to touch, right? Instead of saying which are the stocks we want, we will say which are the stocks we do not want. So it's a rejection stage.
Okay.
So let's say there are some 300 stocks, in small micro cap, and maybe 400 stocks, and then we'll say, oh, these stocks do not go well with value investing. Maybe because their valuation is too high, maybe their quality is too bad, or something or the other is there, right? So we will use fundamental filters to reject that specific set of stocks and say out of say these 300 stocks, these 125 or 150 look good,
Mm-hmm.
right? So then we come to the third stage, is what we call a yellow flag stage. So the first is tactical management. Second is a red flag, where you say, no, this is dirty, I won't touch it. And
Sure.
third is a yellow flag stage. Now, at yellow flag stage, we will see what is the kind of strategy it is.
Mm-hmm.
So, say Tornado is a value strategy. So, we'll use value as a primary factor. And we already are, by defining the universe, using size as a factor, the smaller size companies.
Mm-hmm.
And then we can use quality,
Sure.
right? And a bunch of other factors, and we can give them a weight, you know, which is a human thing to do, to say which is, which is context, to say which factors are more important.
Sure.
Take out a composite score for the entire, say, 125, 130 stocks, and then rank them.
Mm.
This is the best stock according to the factors, and this is the worst stock. Now, it does not mean just because the stock is on the top, we should buy it. So we come to the next stage, the fourth stage. It's called green flag. These are good ones, So green flag looks mostly into the position of the stocks, into say, is position building up? See, uh, how do we figure out position is building up? When human beings find interest or disinterest in something, or do any kind of analysis in the stock markets, they can do only two things. They can either buy a stock or they can sell a stock, right? Or they can hold it if they already have it, right?
Yep.
So buying and selling of stocks works with also a certain set of behaviors, not with just one. There will be machines, there will be algorithms, there will be people who will be buying or selling in a pattern,
Mm.
and those patterns will express themselves in price or in volume, and you can see a bit what is going on,
Mm-hmm.
right? So you can figure out these stocks out of these, say, 135 stocks, and you want to consider, say, top 10, 15%, or maybe 20%. You shortlist 25 stocks and say, out of these stocks, these 10 seem to be moving.
Mm.
Are we ready to move? Got it?
Got it.
So the green flag will say that maybe rank number one isn't ready to move as yet. Let's go to rank number two. Or this moves, and say rank number seven moves, and nine moves, and 10 moves, and 11 moves, and 15 moves. So you'll get a short list of those stocks. Why do we want to pick up those stocks which want to move or which have the probability to move? Let's say there's nothing definite. Is because we want a better CAGR
Mhm.
than just being right of holding the right stocks and then sitting for them forever.
Correct.
There's other strategies which do that also, but they work differently. So, basis on the objective of the strategy, which is say for this come is value investing, is creating wealth. We will, define these criteria. Now, say we bought a stock. How much should we buy the stock? Is a final question. Is position sizing. So, say this portfolio buys 10 stocks. So, we'll say by a default, let's give it a 10% allocation for each stock, make 10 buckets of 10%.
Mhm.
Now, should I buy 10% out of 10%? Or should I buy 9% or 8%? Again, that is the confidence we ascribe to the stock. So this stock looks like working and it seems all the signal says buy, but we have a 60% confidence to
Mhm.
buy. So we'll say let's put in 6% out of the 10% allocated to the stock in it right now and wait for the rest and let things happen and then we can deploy more capital into it,
Sure.
right? So that's position sizing. Position sizing is a way of expressing your confidence and mitigating risk.
Risk.
That you can't. It's not a black and white. Right? And I'm sure of this company will go up. What if it doesn't go up? These things happen a lot in the market. So you can be very sure, but then uh, the market doesn't see it that way. What can you do about it, right? So you will position size and put in you know functions of how much capital to be put when and by when decrease increase and then so once those are determined then you deploy and then on a weekly basis you keep on checking further signals whether they hold true or not. Now, if a signal has changed a bit, it does not mean you sell the stock. It means you can express position size and
Sure.
then change its confidence. So if a stock has we also look into three kind of signals into a stock's value, growth, and sentiment. If all three are there, then say for a ten stock portfolio, the maximum you can invest in a stock is say about 22.5%, right? So that's why certain rules we follow. And say if the signal is 2 out of 3, then the maximum you can go is about 15%. And if it's 1 out of 3, then you can go to 7.5%,
Mhm.
right? At most. So there will also be portfolio level global rules which say that fine, you like the stock, but it cannot be like 50% of your portfolio. Then
Correct.
was being a professional manager and anybody who's making their portfolio out of their heart, of their heart's desire. So that's what we do. So this process keeps on happening again. Every week we will see tactical management signals. Then we will see whether the stock is a red flag or not. Then we'll see whether it's still in the top quartile or not. Then we'll see whether its technical signals hold true or not. And then we'll say whether it's meeting its position sizing rules or not. So keep on doing that. So when some of our clients, wealth management clients, ask, we pay you. Do we? What do we pay you for? So they don't pay us for making money. They pay us for being aware of it every day, each
Sure.
week. Following it up and making sure that the portfolio is functioning well. So whether this stock will go up 100% or 300%, nobody knows when you buy the stock. Later, if it goes, fantastic. And then the signal, of course, the decision always comes whether after 300% you need to keep the stock or need to sell it.
Mhm.
That depend on the objective of the strategy. If it is a value strategy and the stock has gone by 300% and it's above, it's a fair valuation and into extremely expensive valuation, we'll sell it. Not because we feel it's expensive, because the strategy's investment objective says so. And if it's a growth strategy and it's gone up by 300% and we are looking at some bit of momentum into it, then why not let it run more? Let's keep it. So depending on what the objective of the strategy is what we will do. We'll have those five, steps which we keep on running. Those five steps are like simplification of a lot of
Right.
steps we do inside them, right? But then you have to do it over and over again. It has to be a consistent process.
Mhm.
So that's how this runs. Our job is to ensure that the consistency is there and the process is in place and there's a logic and there's a reason and there is some sense behind decisions. Not just you're looking at a head and shoulder pattern and saying, "Oh, the reverse head and shoulders will go up." That's a good starting point, but then you have to have fundamental reasons and you have to have, you have to compare it with the rest of the stocks. You are considering that. So yeah, that's how it works.
I think you've simplified a lot of complex stuff into five simple steps, like of investing process, and I think it's a great way to understand markets. I have a lot of questions to dig deep. Instead of this traditional barbell strategy, you have a tactical market strategy, especially for the first stage of the process, right? Taking the call to which asset to go. So let's say like there are multiple signals like in the macro environment. It could be liquidity or money supply or technical indicators like moving average, as you said. There are so many signals and indicators. So, what do you think is the most reliable or strong indicators that can help you to take this call for which asset to go, like to go long on equities or go long on gold or debt? How do you make that decision?
So, see, ideally, I would say the best way to go which asset to select, is valuation,
Okay.
right? But valuation is tough thing to do across the market. The
Mhm.
indices and all these big companies, on the big houses, try to evaluate the market, and you have to be econometrically trained to, look at it in a way. But then if you go on to gold or if you go on to other assets, it's very difficult to evaluate them because the information required is usually not available with, most investors.
Mhm.
And even with a large investor who has, infinite amounts of resources or investment manager, it is still, a very difficult thing to assimilate, right? So we will see the relative value
Mhm.
between assets. But then after valuation, you have to see, one of the things you also have to see is momentum,
Mm.
right? Momentum is a very mysterious anomaly, and there have been many attempts to define why it happens and how it happens. If you ask me exactly how it happens, it happens. My job is to understand what is happening rather than always why it is happening, right? Because that's what investment managers do. They understand what is happening, not why it is happening. Sometimes you have to just take things as because they're happening, and then you have to mitigate the how if you don't know the how. Why it is happening, you have to mitigate in the how. So which asset is mostly relative value
Mhm.
to which assets, and then there is also sentiment.
Mhm.
There is always a grapevine, which you can hear out from the market, and then you have to have a way of quantifying it, right? So for example, some of my clients who believe in us, sometimes they don't even want to know the performance of the portfolio, but once in a while they will call us and ask. Oh, one of my clients, for example, in 2021 October, called me up. He says, "Yo, this Bitcoin is going up very high.
Mm.
What do we do with it?" I said, "Like, why have you now woken up to the Bitcoin?" Right? So we don't do anything in Bitcoin, but we were tracking it back then, because it was quite of interest and everybody used to ask us. So I said, now that you have woken up to Bitcoin, who doesn't even know what Bitcoin is, it means something must be up with Bitcoin, which usually means that, as the adage goes, when your pan wala and your chai wala is giving you the stock tip,
Yeah.
it's time to sell, right? So we knew that somewhere in October 2021 there was something bad happening, and then later on December most of the bad things already had happened, right? And then I any gathering I would go to, would automatically people get to know, oh, this guy's an investment advisor, let's ask him what to do with Bitcoin. So we used to get a query like, I've invested 10 lakhs in Bitcoin and other coins, and it's for the long term, I've forgotten it. I said, like, now people are putting in their throwaway money. People have a throwaway set of money which they want to take risk with into Bitcoin, which means it's the end of the cycle. When the common man is waking up to something, It's the end of the cycle, So one of you have to add the context of sentiment to the signals. So you can have a time series which tells you what is the relative value, and you can have economic data reports coming in, and you can read them, and you can figure out, that's it's valued, undervalued. But also the exact timing comes from understanding the sentiment,
Mm-hmm.
and then over the period of time you start to link sentiment with the shape of the price patterns. So market is sloping like this, and suddenly it starts to slope like this, and there is a sentiment of oh, everything is happening very fine, and we are keep going to keep going up, and the world is glorious. So as a investment manager, you understand that markets work in cycle,
Mm-hmm.
and it might be near the top of the cycle. So you tune your algorithms to be more careful about exits, right? You don't always get the top. We never get the top, but we get somewhere around it, to exit. We try to exit somewhere around it. Similarly, you never get a bottom. In the bottom, everybody will be talking about that the stock market is finished.
Mm-hmm.
It is over forever, and it is not going to come back. So then we tell our clients, listen, if the large caps finish, then you should burn your money anyways, because it's going to be useless. The large caps are the economy of the country. If they are not producing tax and producing output, and they're not selling as businesses, then anyways your money is useless, for any country. And so that's where you get to understand the context. So you will have time series, and you will have economic data, but you will have to add the context to it as common sense.
Mm-hmm.
So that's what we do in quantamental investing also. We say mostly let machine do the raw stuff and
Mm-hmm.
say, oh, this is the probability, but then you have to add context to it as a human being,
Sure.
because human beings can best add context to human lives. And then you have to have survived a couple of cycles. I wouldn't say I would have survived many cycles. There are people who have survived 50 years, and they've seen like maybe 20 beer markets, 10 beer markets, small ones and big ones, and crashes. But yeah, I've seen about six beer markets,
Mm-hmm.
a bunch, and two crashes, at least two bad crashes. One was 2008 and one was COVID. And yeah, then you put in the context. So that's how you figure whether you want to be in the market or not. And then you have to figure out the simple question you need to ask yourself. You have to reduce it to a simple question: is it worth taking the risk right now,
Mm-hmm.
or am I just going with the herd, or going with the flow? So you just have to, you can keep running with the herd, but you have to just take a pause and say, let me just zoom out and see the broader picture. And then data and analysis will fall into place, and they will give you a broader picture. Are we 100% accurate? Not at all. For the large timing signals, the algorithm also gives about 70 to 80% accuracy only. For stock signals, it gives about maybe 51 to 55% accuracy,
Mm-hmm.
and that's a lot. But then if you put in position sizing rules and safety rules, then you can do well. So you can't pick out the winners, but you can see that some things can be losers, and then you will still pick out some losers. Will not work out to the way it is. So yeah, that's how we time the market. It's a tough job.
Absolutely. Talking about cycles, what does your system predict for 2024? Like, are we on top of the cycle or in between? What does it say?
Good question. So our analysis is up till the last week, and the new data point for the quarter will be finalized today after today's close. So markets valuations are a little high, no
Yeah.
doubt about it, right? But to our understanding, they usually stay high for a bunch of quarters till we see a downtick.
Mm-hmm.
So when we use valuation, we use an indicator called value score, right? And
Okay.
we classify the stocks of the NSE 500 into different buckets, as in discounted, and right priced, and expensive, and trended, right? So right now about 20% of the market is trended in the 500 stocks, and sometimes the trended bucket goes up till 50-55%,
Mm.
right? So that means, and it's only it's been doing increasing in trended from about 2%, 3% trended from the last two quarters to about 10-15% to now 20%. So it's not shown a downtick of the number of stocks which are trended,
Mm.
right? So last time it showed a downtick was 2021,
Mm.
in September to December. There is showed a downtick of number of stocks trended. Then we would say yes. Markets are in momentum mode. They have been very high, and now we have seen a downtick where people say, "Oh no, no, it's going to go up still." That's the context. So right now the trended bucket is on. Valuations are high, yes. Uh, are where to find value. About 8-10% of the stocks are still in the value category, right? If I want to do value investing, I will find them there,
Mm-hmm.
about 10% of those stocks, maybe, some 40-50 stocks in the NSE, it'll, 500. And it'll be difficult to sift them out because some of them will be down because of, poor reasons, poor quality. Something has gone wrong with the company. And then you want to find those 10 stocks and then let the momentum, take them up,
Got it.
right? So something is going through a stress, you bought it, and now the stress is gone and it's going to go up. So market is still trended. Uh, 1 quarter, 2 quarters, 3 quarters, I can't say. We never predict much into the future. We only say weekly, monthly, and quarterly is what we are going to look at as per the signals. So right now there is no downtick in terms of value in the trended bucket, right? So it's going to probably increase only. So yeah, quarterly signal is on. Growth signal is on. About 79, 82% stocks, about 82%. We'll update it today.
Mm-hmm.
Are showing growth. So when we use a growth indicator, we say either stock is expanding or
Mm-hmm.
contracting, expansion or contraction, right? So in a bull market, about 60-65% of the stocks are expanding. They are showing growth on a month-to-month basis. So about last month it was about 75, and this I'm not exactly the figure, and this month it's up,
Sure.
right? So we are seeing an increase in growth also, and the US is supporting. US was most stocks were contracted. Now they have started to expand a bit. So there will be a global push also. And sentiment is a little topped out right now. That's why last week we saw that cut for 1 day and then coming back. Sentiment topped out. The markets might stay here and stock positions might relieve themselves
Mm-hmm.
to find into another set of steam, pushing again the pistons and going ahead.
Mm.
So yeah, markets are on for now. We don't see that they're like too gloomy to see. But whether that lasts for 1 quarters, 2 quarters, 3 quarters, or maybe 5 quarters, we can't say. That I'll talk about in the next quarter only,
Absolutely.
as per the indicators.
Sure. We like to host you again to get your view on that. So I think we are towards the end of this conversation. Like we have a small section now. It's about rapid fire. I'll be asking you some quick questions
Oh
and
dear.
expecting some
Big,
interesting
big, big test, huh?
answers. So, like any one investor that you look up to and why?
So, I'll go with two investors actually,
Sure.
and for two separate reasons. So, and actually similar reasons also. Uh, I look at two things, when I want to look at an investor. One is their persistence. Most people will come, invest, have a crash, and die.
Yep.
you know there'll be few people who are committed to investing. So
Hmm.
Warren Buffett is one who's committed to investing. There's Jim Simmons, from Renaissance Capital Technologies. So these people have stayed,
Correct.
and you only make money as an investor when you stay in the markets. Now right now markets are high, a lot of people are going to get into the markets. Then the markets have already performed well for a lot of people, and they will put in more money, and the markets may or may not go high and they might crash again, and then they will sell their holdings and say that the markets don't work and die, right? As an investor, not as a person, god bless them all, right? So they will lose some money and they'll die. But I'm sure these investors also got into their markets when they were high and low, right? Bull markets are great marketing for the markets, right? But the point is to stay. So these two investors, they have stayed. And the other thing I like about them is that they have a process. They stick to what they know, how it works, and that's what they do. And the consistency of the review and the consistency of process comes from Jim Simmons, who was a mathematician turned into an investor, and then this, and even Warren Buffett also has a process.
Hmm.
He says, this is what I understand, this is what I'll buy, otherwise I'll sit on cash,
Absolutely.
and it works,
Sure.
right? So dying, not dying in the market teaches you that you have to have cash at the right point of time, and you have to do what you know. So yeah, these are the two investors that work for me.
So it's not about timing the market; it's about how much time you stay in the market.
You learn timing later, right? Timing does make money. That's what tactical management works on, but you learn it later.
Okay,
The first you have to just sit through the first cycle. Of course, you have to pay the price. You have to pay the cost of sitting through the first cycle, the first downturn. And even experienced investors often, get caught in the downturn and then
hmm,
they sit through it. So say, oh, fine, we mistimed. Now we have our returns are going to be lower, but I'm not going to lose capital by selling it, on the basis of pain. Of course, I also feel a lot of pain when the markets go down, you know so when the timing goes bad, but then I'm paid to take the pain, right,
good,
and make sure that we sit through it.
sure. Any book that you would like to recommend to our investors, apart from your own book, of course?
There was an ISB question also, and the one book I like a lot, which is not actually an investment book, but it's a way of thinking, is called Factfulness
Sure.
by Hans Rosling.
Hmm.
It's an old book now. So Factfulness, talks about how to understand data and what models to use, and it gives you a big shift which happened in my mindset in reading Factfulness was comparison rather than absolutes. So people do a model, and because they put so much effort in the model, and they see the value of the stock should be this much, it's not what your value is, it's what the comparative or the relative value of the stock is with respect to the market, with respect to other stocks in its own sector. So it says compare things, don't
Sure.
get impressed by a big number, and compare this thing. So Factfulness, that's my favorite go-to book.
Any resources? It could be newsletters from fund managers or blogs or anything that you keep going back to keep yourself informed on the market.
I usually try not to read uh, market views from others, because it kind of paints, my view,
Hmm.
and then I don't want to lose the context which I've gathered from the grapevine of other investors, and my own investors, and the market talks. Because when you read the view of another fund house or anything else, then it tends to color your view. And I am somebody who uh, makes it a point that my view should not get colored,
Sure.
right? Because that's the worst thing you can do, is to believe too much in your own analysis. That's why the whole system is in place, to review every month or every week on a logical basis. So there's a blog called Farnham Street,
Yeah.
which talks about mental models.
Mhm.
I keep going back to that blog,
Mm.
and use it as a reference to that gentleman reads a lot of books and he gives a nice summary. I keep going back to that blog and pick up new ideas, and then try to research them more if I like them, and then if they make, if it's not about liking, it's they resonate with me, right? And then try to put them into my trading, but completely go by models, not go by others view at all.
Any one sector that you, or if I could call your systems, are bullish on for the next quarter or the year?
Okay, good question. A typical fund manager will tell you that this sector is good. We do not invest via sectors. We
Hmm.
used to evaluate sectors, but then we found that that analysis is not, leading us anywhere. And we would say, these sectors are bullish or bearish. We go by value, growth, and sentiment,
Okay.
right? So value as a strategy, growth as a strategy, and sentiment as a strategy, quantamental strategies each. So value right now is a little tight, right? There are very limited opportunities. We have to like really sift through a lot of stocks to find some good stocks, and really go into deep to find a make a value portfolio. Growth is robust, and sentiment is also robust right now. So I would say, if you are investing, don't invest in a sector right now. Invest in growth investing right now, because momentum is on. Bunch of months you can ride the market, you'll make good money.
Or if I could rephrase that question, you talked about multiple factors in this conversation, like
Mhm.
value, growth, liquidity, and also momentum, right? What factor that you could be bullish on?
Right now, momentum is a factor to be bullish on, right? If you do momentum strategies right now, just purely seeing stocks which are rising for the past 3 months,
Hmm.
it'll do well. Size has kind of played out a bit,
Mm.
right? Small and micro cap stocks, which was small in size, have already grown well, and in the past 2 weeks, smaller stocks are not growing as much as they fell more and have not recovered as much as the larger stocks have worked out.
Mm.
So momentum is something we are bullish on right now. Value, difficult to find. Size already played out. Uh, don't worry, there's still opportunity in size. I mean, there's a bunch of opportunity in size, but very difficult to find. But momentum is still easy to find. Mid caps and near Nifty 50, next 50 stocks and mid caps, and they have like momentum right now. If you play those stocks, they'll be a good outcome.
Sure. One last question. One key idea or a thought from your book that you would want to end this conversation as a key takeaway for all the listeners.
Fantastic. I will put it out to all investors and all people. So, the returns we say are like stars guiding the way. People look at returns; they're the stars. They're like North Star of investing, but they also make you look up. And when you're walking on the ground, you need to also look down on the ground, right? So don't go by returns,
Mm-hmm.
go by understanding risks. If you know your terrain and you know where the pitfalls are, then you can look at the North Star from time to time. But you have to keep your eyes on the ground to know where you're going. So one key idea from there is that don't chase returns. Know what strategy you are investing in, whether its strategy is suitable for you or not. I am happy to be, in the top. My one of my portfolios in top, spaces on the small case, But then I would love investors to actually understand the strategy than just say, oh, this is making a lot of money, right? Let me put my money into it. That's just doing momentum, right? Just making money to make more money. Of course, it does mostly what makes money makes more money, right? So but then also understand the strategy. So in the book we talk about defining risks and understanding risks and outside and within your own self also, right? I know I'm biased, so I put my decision out to a system, and let the system give me inputs, and I'll then just put my own gut feeling as a small little input into the model, and that's about it. So yeah, returns, don't chase returns.
Absolutely.
Define them.
Really expecting another book from you, especially not on the personal finance, but more on Quantamental and all the frameworks that we talked about
It,
today.
it, it will not be, there is a book in the works. It'll take some time because a lot of things, keep pressing. It won't be on personal finance,
Mm-hmm.
right? And it won't be purely on, an investment methodology.
Okay.
But it'll be more around constructing your portfolio in the right way, what to think. And when you think of a portfolio construction, then all the way of investing also, fits into it.
Mm.
So we run about 18 different strategies, in the
Correct.
US, in stocks, in mutual funds. And mutual funds, when I say it means index funds, right? Index funds and multi-asset strategies. Each of these strategies are mapped to a different need for the investor. Some strategy will be meant for a funding goal, like buying a house, and a different strategy, which runs differently on, say, takes more risks, will be on a financing goal, that you want to go on a vacation, right? I'm just talking about two goals, right? Bunch of goals, people have. So it'll be more around there, that which type of strategy you should pick up for what type of need as an investor. And we will be talking less about the personal aspects of finance, but more about how to construct a good portfolio and how to do integrating investment management into the investor's needs. Yeah, so that's the book we are looking at.
It was a great pleasure talking to you, Sanjit. I think congratulations once again on amazing performance and wishing you all the best for this performance to keep continuing and sustaining.
We hope to make good decisions over and over again, letting them turn out well.
Thank you, listeners. Hope you found the conversation insightful. If you had liked it, please show your support by sharing this with your friends. Do check out our website, superinvestors.club, for more exciting updates on equity markets. Until next time, this is your host Sri Kumar signing off. Thank you.